Hello and welcome to a new video on the channel. Today we are going to analyze a topic that is generating quite a bit of debate in the investment world. Is Apple losing its ability to innovate? To understand this, we will look at a dynamic chart that shows how the company has allocated its capital over the past decade. The image on the screen will serve as the basis for our chart, which will help us visualize more clearly the evolution of its spending on stock buybacks and research and development. Over the years, Apple has been synonymous with innovation. From the creation of the iPhone to the revolution in digital services, the company has managed to stay at the top of the technology market. However, recent financial data has raised doubts about whether Apple is still prioritizing innovation or if it has shifted its focus toward maximizing shareholder value. To put this in context, in the last 10 years, Apple has allocated approximately $700 billion to stock buybacks. What does this mean? When a company repurchases its own shares, it reduces the number of shares in circulation, which tends to increase the value of each remaining share and benefit investors. This strategy is not exclusive to Apple. Many companies use it as a way to return capital to their shareholders. However, what is interesting here is the magnitude of this spending. If we compare this figure with what Apple has allocated to research and development over the same period, the difference is enormous. The company has invested around $188 billion in innovation. Although this is still a considerable amount, it represents only a fraction of what has been spent on buybacks. Let's see how this has evolved over time with the dynamic chart. Observe how, year after year, stock buybacks have remained at very high levels, while investment in R&D has grown at a much more moderate rate. To better understand this situation, it is important to see how Apple has built its success. Since its founding in 1976 by Steve Jobs, Steve Wozniak, and Ronald Wayne, Apple has been an innovative company. In the 1980s, it revolutionized personal computing with the Macintosh. In 2001, it transformed the music industry with the iPod and the iTunes Store. Then, in 2007, it changed mobile telephony forever with the launch of the iPhone. Each of these milestones was possible thanks to a strong investment in research and development. Apple stood out for making bold bets on new products, even when the market was uncertain about them. But what has happened in the last decade? Have we seen similar innovation? Since the launch of the iPhone in 2007, many argue that Apple has not surprised us again with a technological disruption of the same magnitude. While they have improved their devices and developed products like the AirPods and the Apple Watch, the company seems more focused on refining its ecosystem than on revolutionizing industries as it did before. This leads us to ask, is Apple still an innovative company, or has it become a money-generating machine for its shareholders? If we look at the dynamic chart again, we can see that stock buybacks have been a constant priority. The question is, how does this affect the company in the long term? On one hand, stock buybacks benefit current investors since they increase the value of each share. Additionally, Apple has an impressive cash flow, so it can afford these buybacks without significantly compromising its daily operations. However, by allocating such a significant amount of its capital to this purpose, it reduces the funds that could be used to develop new products or disruptive technologies. For comparison, other tech companies like Microsoft, Google, and Amazon have allocated a larger portion of their revenue to innovation and development. Microsoft, for example, has been investing heavily in artificial intelligence and cloud services. Google has expanded its dominance in AI with products like Google DeepMind. Amazon, on the other hand, continues to invest in automation and advanced logistics. While Apple seems to have prioritized stock buybacks over investment in innovation, its main competitors have followed different strategies. Microsoft, Google, Amazon, and Meta have allocated a significant portion of their capital to research and development, betting on emerging technologies such as artificial intelligence, cloud computing, and mixed reality. Microsoft, for example, has been one of the fastest-growing tech companies in recent years thanks to its focus on the cloud and artificial intelligence. Its Azure service has solidified its position in the market, and its investment in OpenAI has led to the integration of advanced AI models into its products. Unlike Apple, Microsoft has allocated a large portion of its capital to innovation in software and enterprise services. For its part, Google, Alphabet, continues to expand its dominance in the AI world with initiatives like Google DeepMind and Gemini, its advanced language model. Additionally, Google continues to invest in hardware with devices like the Pixel and in its cloud infrastructure with Google Cloud, an area where it competes directly with Amazon and Microsoft. Amazon, although still best known for its e-commerce, has achieved impressive diversification. Its Amazon Web Services, AWS, division remains the undisputed leader in cloud computing services, and its investment in automation and logistics is redefining the way distribution centers operate and how products are delivered. Finally, Meta, formerly Facebook, has made a big bet on virtual reality and the metaverse with its Reality Labs division, although it has yet to see the expected financial success. However, it remains a key player in digital advertising and social networks. If we look at these strategies as a whole, we see that the major tech companies are reinvesting a large portion of their revenue into the development of new technologies, while Apple has allocated most of its capital to stock buybacks. Could this affect its competitiveness in the future? That is the big question investors and analysts are trying to answer. If Apple continues this trend, we could see a future where the company becomes less innovative and more dependent on optimizing its current business model. Although it remains one of the most valuable companies in the world, the lack of revolutionary new products could affect its long-term growth. On the other hand, we must not forget that Apple still has interesting projects in development, such as augmented reality and the Apple Vision Pro. The question is whether these initiatives will be disruptive enough to sustain its leadership in the tech sector. The chart we have seen today gives us a clear picture. Over the past decade, Apple has allocated a significant portion of its capital to repurchasing its own shares, while its investment in R&D has been considerably lower in comparison. This has benefited shareholders in the short term but could have implications for the company's ability to innovate in the future. Now, the big question is, will Apple be able to maintain its leadership position with this strategy, or will it need to change its approach to remain an innovative company? Leave your opinion in the comments. I would love to know what you think about this topic. If you found this analysis interesting, I invite you to watch my latest video, where we explore which of the big tech companies is making the biggest investment in artificial intelligence and how this could redefine the tech market. See you in the next video.